Hey, it's Tom here and welcome back to the channel. So for many new investors, high growth companies are a really popular option. To many people, it makes sense that if a business is growing fast and expanding its operations, generally speaking, you would hope that the stock price would follow. And there are a few examples of where that has worked really, really well. Businesses like Apple or Amazon or Monster Beverage all come to mind as companies that have grown their earnings and their cash flows for an extended period of time, and the stock price has followed and it's provided great returns. But the unfortunate thing with many of these high growth businesses is that there are even more examples of businesses that initially promised high growth but frankly just haven't worked out. Even as I'm filming this video this morning, there was some big news about a company called Peloton, which I'm sure many of you have heard of, which just did a big recall on many of their treadmills, and the price went down 15% in a day. It's now down 50% since its peaks just a few months ago. So when you invest in many of these high growth companies, a lot of times you're paying a very high price, and in order for that price to be justified, the company really has to continue to execute really, really well on constantly growing the business and expanding operations at a really fast rate. And the risk with many of these high growth companies is that if they don't meet these growth rate targets, oftentimes you can see a situation like Peloton, or perhaps with something like the A2 Milk Company here in New Zealand, where the stock price can come down very dramatically if they don't continue to grow at a fast rate. And on the other end of the spectrum, if you invest in really low growth companies and you pay really low prices, if those businesses actually perform a little bit better than people maybe initially expected, they can actually provide surprisingly high returns. So in this video, I want to give a case study of 3 businesses that I would class as low growth, or in one particular example, even negative growth companies that have actually provided really, really good returns due to particular nuances that were kind of going on in each of those situations. So firstly, I want to present sort of what Peter Lynch might call an asset play, a business that had a lot of assets that were underappreciated and were kind of being beaten up at the time because of the fact that they probably over leveraged themselves and perhaps taken on a little bit too much debt. The second example is a business that is not a good business at all, but was producing really good cash flows for a short period of time, and for a short period of time it made it a really attractive investment proposition. And the third company I want to present, so hang on to the end for this one, is basically the holy grail. It's buying into a business where the price suggests that even if the business doesn't grow, you're probably going to earn something like 10 to 15% per year. Really good returns over a long period of time. But what actually happened is the narrative changed, the business got better, the business actually started to grow, and then it provided massive returns well over and above the 10 or 15% per year. So stick around to the end for that particular business. It's a company you've probably all heard of, and it's just been a spectacular home run for investors. And in all 3 of these examples, these businesses, if they didn't perform particularly well, had quite limited downside. They were quite the opposite of many of these high growth companies, where if they don't execute on their growth continually, you're probably going to get slaughtered. Rather, they were businesses that even if they did really poorly, you're probably going to get pretty good returns. And if they could make any sort of improvement in the business, you were going to do spectacularly. Okay, so the first business I want to talk about is actually a company that Mohnish Pabrai wrote about investing in his book, The Dando Investor, which is one of my favorite investing books. And that is a company called Stewart Enterprises. Now, Stewart Enterprises is a funeral services company. Now, that is not a particularly exciting industry. It's not a high growth industry, but it's an example of a company where Mohnish Pabrai was able to make really significant investment returns with, as he saw it, basically no risk. Now, basically what happened with the Stewart Enterprises is they, like I say, are a funeral services company. Mohnish Pabrai invested in this company in around 2000, 2001. And he initially came across the company because it came up simply in a screen of really low PE stocks. It came up as a business that was only trading at like a PE of 3, which is pretty rare, and it caused him to do some more digging into that business. So this was the story with Stewart Enterprises. Basically, the popular thing to do in the 1990s with funeral home businesses was to basically go out and roll up a whole bunch of small mum and dad kind of funeral homes into one overall enterprise. So Stewart Enterprises ended up going out in the 90s along with a handful of other funeral services businesses, and basically just bought up all these mum and dad funeral homes. They acquired several of these companies. At one point, Stewart Enterprises owned about 700 funeral homes and cemeteries, and they basically acquired these by taking on a lot of debt. And what happened with one of their competitors was that the business basically took on too much debt and went bankrupt, and that really sent a lot of fear into the market around what was going to happen with other funeral companies like Stewart Enterprises. Stewart Enterprises themselves were pretty heavily laden with debt. They had about $930 million of long-term debt, with $500 million of that coming due within about 2 years after Monash Pabrai was looking at this investment. And basically the consensus by investment bankers was that Stewart Enterprises was just not going to be able to produce enough cash flow in order to meet that $500 million debt payment. But Monash Pabrai saw it differently, and when he was actually looking at the stock, Stewart Enterprises had gone from $28 per share all the way down to $2 per share. It had been absolutely smoked in the stock market. Now, funeral services is actually a surprisingly good business. They don't have a lot of growth. Populations and death rates are not growing at 10 or 15 or 20% a year like some tech companies, earnings might grow. But they're a very stable business. They, in fact, have one of the lowest rates of business failure of any type of company. There are very few young entrepreneurs that want to get into the funeral services business and start to compete with existing players. And it's not the type of business where people really shop around. Often if they have a loved one pass away, they will go to, a funeral home that their family has used in the past and so on. They're not sort of shopping around for the low bid. So for that reason, these businesses generally produce very stable cash flows and could arguably be valued at 10 or 15 times earnings, pretty simply. And here was this business trading at only 3 times earnings. If you look at a company today even by the name of Carriage Services, which is actually where Stewart Enterprises now sort of lives, they are trading at closer to 20 times earnings. So when Pabrai was looking at the stock, it made him very, very interested. So this is basically the rest of the situation with Stewart Enterprises and what ended up playing out for Monash Pabrai in this investment. So he was pretty confident that funeral services were actually a pretty good business, but of course they had this big debt problem. And the way he looked at it was that Stewart Enterprises had about 700 of these funeral homes and cemeteries, and they were probably worth about $4 per share after backing out the debt. So keep in mind, Stewart was trading at about $2 per share at the time, so he thought that it was trading at about half of its liquidation value. If you just wound up the company today, sold everything, even at distressed prices, paid off all the debts, you're probably going to get out about $4 per share. And the business at the time was producing free cash flows of about 70 cents per share. So it was trading at very low multiples of earnings and free cash flow. Now, where the problem comes in is that Monash Pabrai was forecasting that Stewart Enterprises would probably produce roughly $150 million in free cash flow between the time he was looking at it and the time that this big debt payment was due. And that would leave a deficit of about $350 million that they were short in terms of being able to make their debt payments. And he essentially saw that there were only really a handful of outcomes that could happen for Stewart Enterprises. He thought either they could sell off a portion of the funeral homes that they have, maybe something like 1 to 200 of their funeral homes out of the 700 that they own in order to pay off that debt. He thought they could roll the debt out potentially a little bit further down the road, which is, refinance the debt and push that big debt payment out a few years, or even take it to an entirely new lender and do basically the same thing, roll that debt out to a longer duration. Or he thought that, frankly, Stewart Enterprises could go bankrupt. And even in that case, the way he viewed it was that Stewart had such a massive amount of assets relative to their price that even if they went into bankruptcy, liquidated the business and, paid out any cash to shareholders that was generated from that, even by selling, the funeral homes at distressed prices, he still thought that in that case they were going to get about $2 per share. So on the worst possible scenario of bankruptcy, Monash Pabrai saw that he was probably expecting to get about $2 per share back. The current price of the stock was $2 per share, so as he saw it, there was basically no downside unless his final scenario came into play, which was a meteor hits Earth and destroys all the assets of Stewart Enterprises, which of course didn't happen. Now, basically what played out is that Stewart Enterprises management went on to sell about 20% of their funeral services assets. So they actually ended up doing something slightly better than Monash Pabrai even imagined, which was selling some of their assets, but actually having no negative impact on free cash flows. So they chose to sell several of their international funeral homes and cemeteries, and these were actually all pretty low performing assets, business sort of segments within Stewart Enterprises that actually weren't producing positive cash flows at all. So suddenly Stewart Enterprises had enough cash to pay their debt obligations, they had no negative impacts on cash flows or earnings at all, and the stock rallied from about $2 per share up to about $8 per share within only a year of making that investment. So it was a 4x return in 1 year for Monish Prabrai, and he was able to capture that return in a business which basically had very, very slow long-term growth prospects in a super boring industry, and he was able to do that in his mind with next to no risk of a permanent loss of capital. Okay, so the next company is a business called IPSCO. Now, this is actually a story that I've told before, but I thought I would share it again quickly in this video. Now, IPSCO is a business which had very strong cash flows at the time. Again, that Monish Prabrai was looking at it. So you're getting two back-to-back Prabrai investments from me here. The third one is not, but the third one is a holy grail of investing, so definitely hang on for that one. So IPSCO was a tubular steel business that Monish Prabrai invested in the early 2000s. And again, we're talking about low growth businesses, and IPSCO is certainly a good example of that. For IPSCO, it was not only a possibility that earnings may go down a couple of years out into the future, but it was actually a probability. It was likely that IPSCO's long-term earnings would shrink down from what it was likely to do in the next couple of years. But nonetheless, it turned out to be a really good investment for Monish Prabrai, and this is what happened. So IPSCO, like I say, is a tubular steel producer, and basically what was unique about IPSCO at the time is that they had these long-term contracts, long-term agreements in place with many of their customers who had large projects that required a lot of tubular steel. And this basically meant that IPSCO had an unusual amount of visibility of earnings over the next couple of years. So typically a steel business is very cyclical. It can go through big swings of earnings, very high, very low. It can make a bunch of money one year, it can lose a bunch of money the next year. But with IPSCO, they had a lot of stability kind of forecast out for the next couple of years because they had these long-term contracts in place with some of their customers. And that brings along this investment case. So at the time, IPSCO had about $15 a share in cash with no debt. They were forecast to earn about $15 per share each year for the next 2 years with these long-term contracts, which meant that if we fast forward 2 years, suddenly IPSCO has about $45 in the bank per share. Now at the time when Prabrai was looking at it, the current price of IPSCO was about $45 per share. So that meant that if you fast forward 2 years into this investment case, you were going to have a business that was trading at cash, and at that stage you would have been getting the business, the expertise, the customers, and so on, the physical assets of the company all for free. And he felt that if that was able to happen, the share price would be very likely to go up because those things don't typically trade for free. And this is essentially what happened. So we fast forward a couple of years, IPSCO did produce those cash flows, and they actually came out and said, we've got a little bit more visibility of earnings out over the next couple of years, and we're going to continue to earn $15 per share. And the stock price then went from about $45 a share to $90 per share. It ended up being bought out by a Swedish company for about $150 per share, and Monish Prabrai sold out at that point before the acquisition actually went through, but the price shot up very close to that $140, $150 a share mark. And again, he captured about a 3x on that investment in only 2 or 3 years' time, again in a business not only with very low growth, but a business that was likely to have declining earnings after these long-term contracts ran out. Okay, so that brings us to the third and final company that was, as I described it earlier in the video, the holy grail of investing. Buying a business that was really not growing much at the time, and it turned out to produce pretty good cash flows over the next couple of years as it continued to not grow but continued to be stable. And then it turned into a growing business that just exploded in price over the following decade. And this is a business that you all know, and that is a company by the name of Microsoft. Now, Microsoft is a company that I've brought up several times on the channel as an example of a business that got really, really overpriced in the tech bubble. From about 2000 to about 2015, the business did okay. They continued to produce a lot of cash flow. It's a really good business, produces a lot of cash on a fairly small asset base. But the stock price basically went nowhere, and that again is an example of overpaying for a growth company and just not getting the returns that you'd hope for because they hadn't continued this sort of stellar, crazy growth rates that had been promised back in the tech bubble in this case. But it got to the point in about 2011 where Microsoft was actually getting pitched by value investors. It was no longer seen as this growth stock. Rather it was this really stable, really cash flow generative business that was trading at quite cheap multiples simply because the stock had gone nowhere for about 10 years or so at that point. And this was starting to get pitched at value investing conferences. I've heard Toby Carlisle talk about that a little bit. If you go on Value Investors Club, you can see old write-ups of Microsoft from around this time with people pitching it as a really kind of cheap stock. And this was basically what was happening at the time. So in 2011, Microsoft was producing about $2.50 per share in free cash flow each year. Now, alongside the $2.50 you were getting in cash flow with basically no growth, it was fairly stable cash flows, kind of either side of 2011. Alongside that $2.50 per share in free cash flow, they also had net cash of about $4.25 per share. So if you factor all that in, you're paying about a free cash flow multiple compared to the enterprise value of about 8 times free cash flow. So if you looked at the business at the time, you got $2.50 a share in free cash flow. The stock price was about $25. So it's about 10 times free cash flow, but if you factor in that cash, it was really only about 8.3 times cash flows if you look at it on an enterprise value basis. So if you invert that free cash flow and enterprise value multiple, so if you go 1 divided by the multiple you were paying of about 8, you were looking to get about a 12% free cash flow yield on that business, which is a very attractive return for a good company producing good cash flows with very sticky products and a very sticky customer base. At this time, they'd just released, I believe, Windows 7 at the time. And there's not a whole lot of churn off Microsoft to Apple, and there's not a whole lot of churn off Apple to Microsoft. Most people tend to stick with one of those two operating systems and kind of just stay with that indefinitely, right? So that's the type of business that you had as it stood in 2011. And from 2011 to about 2013, 14, that basically continued as status quo. They continued to produce roughly $2.50 per share in free cash flow. They actually started buying back shares a little bit. And it just continued to be a good, steady business that produced solid returns over the next couple of years. But what happened next to Microsoft is super interesting and made this investment an absolute home run and turned it from a 12 to 15% cash flow, asset per year into a just monster kind of capital growth engine. So basically what happened is Microsoft transitioned their business from selling basically licenses to use their Windows operating systems to more of a subscription model, and they also grew out the suite of Microsoft products as they've had a history of doing for a long period of time. They introduced Azure, their cloud services business, in the past few years as well, which has just been a massive growth engine for Microsoft overall, and it's a really high margin, really profitable business. And basically Microsoft has now gone from earning about $2.50 per share in free cash flow in 2011 to earning about $5.90 per share in free cash flow in 2021. That's been a combination of a couple of things. They've experienced very genuine growth, but they've also bought back some shares when they were cheap and they were down at those low multiple kind of levels. And the other thing that's happened is since the story has sort of changed for Microsoft, they're no longer trading at 8 or 10 times free cash flow. They're now trading at north of 40 times free cash flow. So you've not only got the genuine business growing, you've also got this multiple expansion and people willing to pay more for every dollar of cash flow and dollar of earnings that Microsoft produces. And for investors, it's just been spectacular. So if you had bought Microsoft in 2011 and held it right through till today in 2021, you would have captured about 25% per year plus dividends. So dividends have been anywhere from 1 to 3% per year. Let's just call it 2% per year. So you would have compounded your money at about 27% per year from 2011 through to 2021. So on one investment over a 10-year period, 27% per year, just a spectacular return in anybody's language. So there you have it. That's an example of 3 different businesses where initially, at least when the investment was made, the growth prospects for all of those businesses did not look spectacular. But nonetheless, all 3 of them provided really, really good returns. And in the case of Microsoft, when the story did change and it did become a really high growth business again and a high flyer, high multiple business again, you kind of got the best of both worlds. You got the really good, strong cash flow generation when you first invested in it. Even if it didn't grow, you probably would have got 12 to 15% returns per year, something like that. But the story changed, the business got better, and you ended up doing substantially better than the 12 or 15% per year. So I do hope you enjoyed the video, and I hope that opened your eyes a little bit to the fact that you don't necessarily have to invest in really high growth companies to get really high capital growth in your portfolio. So if you did enjoy the video, please hit like and hit subscribe, and I will see you in the next one. Cheers.